this storyline here, where we look at that and see that rejection of that low price, we start looking now at this as being the low of your profile before it even shows as a low of a profile. And this gives us a great opportunity to trade that brilliant profile trade called the double distribution higher, but without waiting for the profile to ever show that story when it's usually, in most cases, too late. Do we see any more? Do we see any more? Well, we can obviously recognize that there is another higher low volume profile here. Agreed? And again, the storyline based on that is if we parallel shift this and we do this line from there to here, we can start looking at those areas as well. That basic storyline stays in play. And obviously we know that we have an area here which we can now highlight as a real thing here. And obviously as we highlight that as a real thing, we know that this is a profile low distribution before it develops. It's a forecast, in other words. In other words, what we've accomplished here is we're actually forecasting market profiles 80% rule, and I'm glad Jack brought that subject up rather than myself. It's always better to hear somebody else mentioning the 80% rule so that we can actually start recognizing that other people do know this concept but haven't been able to identify its real existence. But this is what we're doing here, Jack. So what I'm saying to you is that when we trade that low price there, you are now in your 80% rule trade here. Now, you might want to wait for the price to roll round and start pointing in the right direction. That wouldn't be always a bad thing to do. But obviously, if you're trading the 80% rule, the idea is, well, the 80% rule is that we should trade all the way back basically to the prior, not necessarily the prior swing high, because the rule doesn't say you go back to the prior swing high. It says you'll trade through the prior balance area to the through the high volume node to the low volume node area. So it doesn't tell you that you're going to take out the high price, but it tells you that you're going to trade up to this area here with an 80% probability, and you're going to trade up to this area here with an 80% probability. Well, according to those last two trades there, that 80% probability seems to be 100% probability, does it not? Seems to be. And then we see the profile evolving again, and we see whether it's still doing what we hope it's doing, and that's still rising in price, and it is still rising in price. So obviously we then look at doing the same thing. We're saying, well, it's still the same, Ray. Brilliant. What does that mean? Well, if I get a low volume node against the swing, we're going to go again. Do we get a low volume node against the swing? Well, we're coming into the area here. We're coming into the area right there in that red candle. It's time to start looking. It's time to start thinking about Jack's 80% rule. And if it's the 80% rule there, the target price of that is to roll the price up to this target level here. And yet again, you're successful with the trade. Yet again, your 80% rule works out. Yet again, you've just made an absolute killing on that bit of business. So what do you think of this? Well, you might say, what about the sell trade? I can see a sell trade. Is that not a thing? Well, what sell trade can you all see? Well, we've got a lower profile here, have we not? Absolutely, right? We've got a crazy lower profile there. It's a crazy time of the day, of course, and let's see if crazy still works. And obviously we're looking now using the same set of rules. We can now look at this as a low volume node area here. And obviously based on that low volume node, you can obviously recognize that this accelerates very quickly. The only challenge I've got to that acceleration is one of those little nuances. And the nuance there is that the speed of that acceleration there has got pretty fast candles coming away from that price level here. You know, you've always got to remember that there should be a slow narrative associated with any of these trades, not a fast narrative. So I'm a little bit concerned about that high profile area. So, I mean, if you're concerned, there's an easy solution. You pull back to the next peak, which is now this peak between the two POCs, right? There's the two profiles. There's the pink profile there. There's the pink profile. So that's the highest peak. Draw a line against that highest peak again. And this is now going to be an area that you're going to be looking at as a low volume area. And obviously, if you're looking into that low volume area, you see we've actually came across a pin zone. So obviously, when we come across a pin zone, well, we know that this is interesting because obviously that's quite an expansion at the bottom edge. Now we're starting to see quite an expansion. And obviously, if it's now driving far enough that this is now a distribution up here, you can start to look at that and say, right, we're going to start working on it. And sure enough, yeah, we do have to come back and get some more business at a higher price. But the idea is that 80% of the time, this low volume node here should travel back to this price here, at least 80% of the time. And obviously it does, and that's another winner. So that's, if you count this as a winner, so obviously you could dispute this one, but we get a winner here, that's 1. We get a winner here, that's 2. We get a winner here, that's 3. And we get a winner here, that's 4 out of 4. And that's over the course of between the hours of 5 o'clock in the morning and 9 o'clock in the morning that day. 4 out of 4, 5 out of 5. Perhaps if you counted these as 2 trades, maybe you count this one as a scratch. Then, of course, you're looking at 4 out of 4, for sure 4 out of 4 winning trades using the 80% rule. So Jack's right when he's talking about the 80% rule. The idea that when we see that low volume node, but we've adapted that rule, we've improved significantly. My belief is we've improved that rule significantly, way beyond what Stadelmeier or Dalton ever did. This is leading edge for profiling, really, isn't it? It's like the best profiling you've ever seen in your life because it is market adaptive. And it doesn't necessarily mean that we're looking at this trade purely from those levels. We can actually don't need to see the background narratives at all. We can actually make this read from anywhere in our charts. Can anybody see another possible buy trade opportunity that I've not talked about that doesn't involve the shakeout zones? Anybody see another buy trade? Well, this comes down to the concept of recognizing this concept of probability distributions. If I look at this buy trade here, and I look at this peak here to this peak here, and I look at the price from that peak there to that peak there, is that a normal buy side distribution? Yes or no? Yeah, so in that period, what should be happening to the POC? The POC should be moving higher. This should be a double distribution higher, right? If that's the case, should I be able to rotate off the low volume node? Yes. Can we identify where the low volume node should be? Can we identify where the low volume node should be with 100% accuracy? Well, we look at where the peak is here, and we look at where the peak is here, and we look at where the lowest trough is here, and we draw a line. Yeah? So when we draw that line, can I now look at that price as the low volume distribution price to buy into? So when we trap into that low volume distribution price there, so long as it's not gone lower than the previous low, because if it has, then that's a normal distribution, right? So we can't afford to let this price go below the previous low. If the price comes down to this area, then rejects back out, you've now got the idea that it's not going to do that. Well, with an 80% probability, we should now be able to rotate through this price area here, shouldn't we? And there's another winning trade distribution. So when you think about it, we've actually done 5 out of 5 winners using profile, haven't we? 5 out of 5 winners. So when we think about this as a profiling concept, and I think Kim was a little bit surprised that I was calling it, because when Kim was asking for a basic outline of this, I said it's basically profiling in the 21st century, right? It's the real way to change the view of how profile works. Then I think Kim was like, I don't really quite get this. I mean, why are we talking about profile where, when it's way beyond, what really has it got to do with profile? I know that's not what she was saying, but, for a lot of people saying, I don't quite understand the connection with profile here. But yet, when you actually now think about it, when you think about Jack's comment, that he actually spent time, possibly one of the few people that spent time in a profiling room, learning about the 80% rule, learning about these double distributions and moving POCs and all these balance areas, and still wasn't able to turn it into money. Just as Stadelmeier suggested, it was almost impossible to turn it into money. What we've done is make the profile dynamic in real time to allow us to start considering these low volume areas that nobody else knows about. Because what the hell is this price area here? Nobody else knows about that price area. What is this price area here? Nobody else knows that price area. What is this price area here? Nobody knows about it. What is this price area here? Nobody knows about it, except for us. These, what we would determine to be the low volume nodes of a distribution that is quite clearly identified as fair value, giving us the idea that the market is bullish, and then buying into this as a storyline, allows us the best possible outcome from a market profile situation. Bearing in mind the market profile situation was going back to discussing this as a profile story, looking at the high distribution and the low distribution, and trying to identify this crazy time frame of analysis where we start looking to find those areas, where what we've actually ended up getting is an adaptive process that helps to identify those areas across whatever time frame we're looking at without having to necessarily keep changing the profile settings itself. It's adaptive because it changes according to what? You may say, I don't understand why you can use or how you can use the word adaptive. Well, it changes according to volatility, doesn't it? So obviously that break to the downside, if it's accompanied by fast candles, isn't going to be a break to the downside, is it? Because it's going to be then a normal fair value distribution if it breaks to the downside at the same time as the price breaks to the downside, at the same time as the spectrometer breaks to the downside, right? Then it's just called fair value. It's a brand new story. It's a brand new potential distribution. A lower low on our HFD and a lower low in price is a fair value distribution. We would then be thinking about the possibility of selling the low volume areas on the way up, and we know where the low volume areas are likely to be. So we start looking. We start looking for those low volume areas where they're likely to be, and we start taking advantage of those opportunities. This profiling is state of the art in terms of its outcomes. You wonder why people like Reeve have suddenly taken to it, because they've seen for themselves that that is a thing. It was one of the first things that Sammy highlighted. It was the first thing I think Sammy actually saw from that was the absorption element, if you like, because looking at it without looking at it from a profiling point of view, looking at it from, for example, a delta point of view, if that was a delta line, you'd be buying this. Well, if it was a delta point of view, we would be buying heavy sell side volume, but it's not actually heavy sell side volume. It's actually a very high probability distribution. Going back to Jack's rule, the concept that profilers use, which is that it travels back through that profile 80% of the time. Well, you've seen 5 trades on that one little bit of charting there. 5 trades and 5 winners if you just followed that process, and it's all very objective. There's very little subjectivity to it. You know, if you can draw a straight line, and we had a challenge with this before, but if you can draw a straight line between that low price and the next low price, and you can recognize that the price has not done a fair value drop, because obviously from that point there, had the price dropped down to there, then you would not be buying this, would you? Because that would be classed as a fair value drop, wouldn't it? It'd be classed as a fair value drop, and therefore it's not a deal, it's not a trade. So we're trying to go after those areas. We start to learn about these fair value areas where we start recognizing opportunities to play. And what happens eventually, and it may well be the case that some of the guys that have used this more often than not, what happens eventually is you start seeing, even between the candles, you start seeing this story. You start seeing the opportunities. You recognize that some of these moves, like this one here, look at this crazy move here. There's no way that's right, is it? It's no way that that distribution is in the correct place. I mean, if you just look at the previous low there, the price should be down here, shouldn't it? So even though it maybe doesn't have all the bells and whistles that you would like, you're starting to look at that and say, this is nuts. This has got to be a buy trade if it's going to be anything, right? Because the price isn't at the previous low. In other words, we're getting a perfect idea, whilst it might not be a double distribution higher, we're getting an idea that it's certainly not going to be a double distribution lower. And with an 80% probability, I'm thinking it's going to cycle back at least back to this price. Now, at that stage, I'm still pretty convinced that you'd agree with me that the green distribution to the green distribution there was still going up. And the lowest low between those two distributions was this price. And therefore, based on that distribution being that price there, you could start looking at that and saying, right, coming into this area, I'm already starting to consider this. Now, there is obviously a few challenges to this because of what's happened. You can see, obviously, if we decided to start buying into this break lower, then, of course, you would have been probably one candle too early. You may have been in this little candle here. Okay, so you rotate the price and you scratch out just like we did over here with the sell trade, and then you go back in again and you take your probability distribution. And all of a sudden, you've had another winning trade. 1, 2, 3, 4, 5, 6 winners in a row. 6 winners in a row by recognizing these areas, by recognizing the potential that these profiling distributions allow you to see. And remember, it is still a distribution. It is still a statistical probability. It's not a statistical certainty. But when you start adding some other components to that, actual delta, looking at trap traders, adding a stacked bid on the limit order book, adding a value narrative, you start finding probabilities way beyond 80%. And this is just the baseline that you've seen here. This is your starting point for 10. You've still got more you can build around this as a storyline, as a narrative to get you going into your trades. You want a biggest edge possible. You want the biggest edge going. And this is an indicator that shows you where that edge is. You don't have to agree with the indicator. You don't have to agree that the edge is tradable. You don't have to agree that the edge is a value story that you're going to take advantage of. But what you must agree is statistically there is an edge. And that's what we start to trade. We start trading these little edges, and we start recognizing that we're now using mathematics to find the edge for us. We're using these distributions helping us to make the right decision possible. And it's amazing when you see that change taking place. The challenges, the way that it evolves, the way that it starts to form. We could argue that there was a possible sell trade, and this is when you start seeing some other clues. What do I mean about a possible sell trade? Well, what if I was to highlight this balance area here, with this low, with this trade here? Can we all agree that the normal distribution is definitely lower than that point? And therefore, in the very short term, there is actually a possible top edge forming here. But what happened when we traded the top edge? Well, obviously, when we look at this trade here, you would say, well, the highest high in profile distribution terms was here. So obviously, when we trade up into that area, we're almost the same price. Almost the same price. So this is starting to feel a little bit like fair value. So if you know that it's starting to feel a little bit like fair value, you maybe give it a little bit more room then. You give it a little bit more space to run maybe the top edge stops, perhaps. And you end up with another trade that also wins. Now, it doesn't cycle 80% of the swing, because it turns out that it actually wasn't, because it actually did go above the prior high, and therefore that turned it from a sell side double distribution to a normal distribution, and a normal distribution is not the same. And because a normal distribution is not the same, we recognize that this is not going to be the same as an outcome. And because we see the probability distribution massively changing to a bullish situation here, well, we know that top edge is going to get wiped out anyway. And it does get wiped out. So that could have been 1, 2, 3, 4, 5, 6, 7 winning trades. Now using this as a process. 7 winning trades. Using this as a process. So when we talk about profiling, we seem to have moved the needle massively beyond the normal view of what a profile does. We seem to have answered a lot of questions that profile guys love, because we all, I would imagine most people love the concept of profiling. Jack loved it. I enjoyed Stoudemire and Dalton's theories. I found them impractical in terms of their application. I found them very, very nice in hindsight to recognize where the dealers did buy and where the dealers did sell and where those low volume areas were. But they're pretty much something that we can always see ourselves by simply looking at a chart. I mean, we take all our stuff off the screens and we're left with a chart that looks like this. And I can look at any part of that chart and I can see that there was a low volume node here. And I can see that there's a low volume node here. And I say to myself, well, and what? And what? What does it mean? What am I going to do about it? What does it mean to me? What am I going to be using it for? Just because I know there's a low volume node in those areas, what am I going to be thinking? Well, I'm going to be thinking that when the price rejects here and it starts coming back up, I'm going to be a buyer. And all of a sudden, holy schmoly, we've just been annihilated here. And then we start looking at this area here and we say to ourselves, right, I've got a beautiful double distribution to the downside here. I'm going to be looking to sell back into the profile high here. And, you know, that low volume distribution area. And when we sell into the low volume distribution there, sure enough, the price goes up. The price goes up. And obviously that's the problem, isn't it? We're not getting that adaptive real-time insight about how the volatilities are impacting on these profiles. We're not getting enough feedback from the price itself in a profile. We're not getting that either on a TPO or a volume profile narrative. And therefore, whilst in theory it's a very, very good product, in theory it should be brilliant, Stoudemire, by his own admission, recognizes that the tradability of the profile is extremely limited. And whilst it gives a great definition of what's going on, it doesn't really give you much idea about what's likely to go on. And on the odd occasion, it does find some spectacular trade levels. But unfortunately, just not often enough to satisfy a lot of traders who feel as if it should have delivered, like Jack, but it just failed to deliver. Well, maybe for the first time, those profile traders actually can see a reality of this as a narrative, a reality where they actually can see a dynamic profile giving them real entries with a real storyline that doesn't take away the storyline that Stoudemire and Dalton painted about things like this movement, this distribution, if you like. It just brings it up to date. It brings it up to speed, and it gives you something that you can trade in real time using real accuracy. You can all draw a straight line. As the price comes into that area, you can then assess the delta situation. You can assess the book situation. You can assess the dealer's keys in that area. You can assess the value that's evolving in that area as well. And from that, we start recognizing real tradable opportunities. And we'll finish at that today without starting to repeat ourselves. I hope there was something of value there. I think it's it's a great process. It's a great process if you allow it to be a great process, like most indicators, if you allow it to be what it is and not expect it to be anything more than that. And obviously what we've got to try and do is just let it do its work. Let it point to those high probability areas and then start working on them. If you can point to those high probability areas and start working on them, you don't necessarily take all of them. You might not take the majority of them, but at least you're in the right area for a profile narrative. At least you're in the right area, looking for the right things. Anyway, have a good one. I'll see you guys in the morning. I'm going to say adios amigos, arrivederci, auf Wiedersehen, sayonara, tot ziens, tasco do, do svidania, and spasibo. Meantime, ciao for now.